Silver just moved again, not during a quiet trading session, not after a routine inflation report, and not during a calm macro environment. Surprised, it happened while pressure inside the global financial system is quietly building. Right now, global debt has surpassed 300 trillion. At the same time, several macro analysts are beginning to discuss something unusual, a potential shift of nearly $1 trillion of institutional capital toward hard assets. That number may sound small compared to the size of global markets, but capital flows rarely matter because of headlines. They matter because of direction. For decades, most global capital flowed into financial assets: stocks, government bonds, corporate credit, real estate. That system expanded during a long era of falling interest rates and rising liquidity, but that era may be slowly changing. Thoughtful interest costs are rising, debt levels are expanding, and geopolitical tensions continue increasing across several regions of the world. When systems like this begin to shift, capital rarely stays in the same place. It starts moving. Quietly at first, institutional portfolios begin adjusting, sovereign funds diversify reserves, and investors begin looking again at assets that exist outside the financial system: energy, commodities, gold, and increasingly, silver. This matters because silver sits at the intersection of two powerful forces. It is both a precious metal and a critical industrial material, which means when financial stress increases and industrial demand rises at the same time, silver becomes extremely sensitive to capital flows. Right now, several signals are beginning to appear together. Global debt is rising, industrial demand is expanding, and capital may already be starting to reposition. This is not noise. This is a signal. If you're watching this channel, you probably already understand something important about markets. Most investors react to headlines, but markets usually move before the headlines appear. Price movements rarely start with breaking news. They begin quietly, inside data that most investors never examine: inventory levels, capital flows, market structure, institutional positioning. Those signals often appear weeks or months before the broader market recognizes them. And that is exactly what we focus on here. This channel is not about hype. It is not about predicting short-term price movements. And it is not about chasing trends. It is about studying the structure of the financial system itself. Because when you understand the structure of markets, you begin seeing signals that most investors miss, signals that appear before the crowd reacts. Silver has historically been one of those signals, not always, but often enough that serious macro analysts continue watching it closely, especially during periods when global financial conditions begin changing. And right now, several of those conditions may already be shifting. Let's start with the actual data, because when markets begin shifting, the first signals almost always appear inside the numbers. Right now, the global financial system is enormous. Global equity markets are worth more than $100 trillion. The global bond market exceeds $130 trillion. And when derivatives and other financial instruments are included, the total size of global financial assets rises to well above $400 trillion. At the same time, global debt has now climbed beyond $300 trillion. Servicing that debt has become more expensive as interest rates have risen over the past several years. Governments are running persistent deficits. Corporations are refinancing debt at higher costs, and central banks are trying to balance financial stability with inflation control. Meanwhile, the silver market itself remains extremely small compared with these numbers. Global silver production each year is worth only tens of billions of dollars. That makes silver one of the smallest major commodity markets in the world. Now consider what happens when capital begins reallocating. If just 1% of global financial assets shifts toward hard assets, that would represent nearly $4 trillion. Even if a tiny fraction of that capital enters the silver market, the impact could be significant, because small markets react much more dramatically to capital flows. Another data point worth noting is industrial demand. Solar power installations now consume a growing share of global silver supply. Electronics, electric vehicles, and semiconductor manufacturing all require silver because of its unmatched electrical conductivity, which means silver demand today is driven not only by investors, but also by industries expanding across the global economy. When investment demand and industrial demand begin rising together, the market can tighten quickly. And that is exactly the dynamic analysts are beginning to watch more closely. To understand why the silver market can behave unpredictably, we need to examine the difference between paper markets and physical markets. Most silver trading today happens through financial instruments, futures contracts, exchange-traded funds, derivatives. These instruments allow investors to gain exposure to silver price movements without actually owning physical metal. This system creates liquidity, but it also creates a layer of financial abstraction between the price of silver and the physical metal itself. Physical silver operates under a very different set of constraints. Industrial users need actual metal. Manufacturers building solar panels cannot use a derivative contract. Electronics producers cannot power circuits with financial exposure. They need physical silver, and when physical demand increases, pressure begins forming inside the system. At first, that pressure may appear in small ways, delivery delays, inventory drawdowns, or rising premiums for physical metal in certain markets. This dynamic has appeared in several commodity markets throughout history. When physical supply becomes tight while paper markets remain heavily traded, the relationship between price and supply can become unstable. That does not mean the system breaks immediately, but it does mean the market becomes more sensitive to changes in demand and capital flows. And silver, because of its small market size and strong industrial demand, tends to react more quickly than many investors expect. To understand why analysts watch silver so closely during periods of financial stress, we need to look at how the futures market actually works. Most silver trading happens through futures contracts. These contracts allow traders to speculate on the future price of silver without necessarily buying or selling the physical metal itself. In most cases, these contracts are never settled through delivery. Instead, traders simply roll the contract forward before the delivery deadline. This process keeps the system liquid and allows the market to function efficiently. But occasionally, something different happens. When demand for physical metal begins increasing, more participants may choose to take delivery rather than rolling their contracts. That is when analysts begin watching a metric known as the coverage ratio. The coverage ratio compares the number of outstanding futures contracts with the amount of physical silver registered for delivery. If there are significantly more contracts than available metal, the ratio becomes elevated. This does not automatically mean a shortage will occur, but it does indicate that the system becomes more sensitive to delivery demand. Another important concept is the difference between contango and backwardation. In normal market conditions, futures prices are slightly higher than the spot price. This is known as contango, and it reflects storage costs and interest rates. But when physical supply becomes tight, the opposite can happen. Spot prices begin rising above futures prices. This condition is called backwardation, and it often signals immediate demand for physical metal. When backwardation appears in commodity markets, it can be a sign that the supply system is under pressure. And that is exactly why traders monitor these structural signals so closely. Because sometimes the most important changes in markets appear not in price charts, but in the structure of the market itself. None of these signals would matter if markets had never reacted to them before, but history shows that silver has often behaved in dramatic ways during periods of financial stress. One of the most famous examples occurred in 1980, during a period of high inflation and economic uncertainty. Silver prices surged dramatically as investors sought protection against currency instability. At one point, silver rose more than 700% during that cycle. Another example appeared in 2011 during the aftermath of the global financial crisis. Central banks around the world were expanding their balance sheets, liquidity was flooding the system, and investors began looking for assets that could protect purchasing power. During that period, silver climbed from around $9 per ounce to nearly $50. What made that rally remarkable was the speed of the move. Gold rose strongly during the same time, but silver moved much faster. The reason was simple. Silver is a much smaller market. When capital flows accelerate, smaller markets tend to move more violently than larger ones. This pattern has appeared repeatedly in commodity cycles. Gold often moves first. Silver lags at the beginning. Then, as momentum increases, silver begins accelerating rapidly. Not because silver is inherently more valuable, but because its market structure amplifies capital flows. And that is exactly why analysts continue watching it closely today. Silver is not just a financial asset, it is also part of a global supply chain that spans several continents. And that supply chain matters more than many investors realize. Today, the largest silver-producing country in the world is Mexico. A significant share of global silver production comes from mines located there. Peru and China are also major producers, contributing large volumes to global supply. But here is the important detail. Most silver is not mined as a primary metal. Instead, it is produced as a byproduct of mining other metals, including copper, lead, zinc, and gold. That means silver supply does not respond quickly to rising prices. Even if silver prices increase, mining companies cannot immediately expand production unless the economics of those other metals justify larger mining operations. At the same time, demand is rising in several major regions. China remains one of the largest industrial consumers of silver, particularly through electronics and solar manufacturing. India has historically been one of the largest buyers of physical precious metals during periods of financial uncertainty. And across Europe and North America, the energy transition is accelerating demand for solar installations, which require significant amounts of silver. These regional dynamics create a complex global system, supply concentrated in certain regions, demand expanding in others, and geopolitical tensions occasionally disrupting trade flows and industrial production. When these forces begin interacting with financial capital flows, commodity markets can become increasingly volatile. Silver sits right in the middle of that system, which is why shifts in global supply and demand often ripple through the market much faster than investors expect. Another place analysts look for early warning signals is the derivatives market. Most investors focus on price, but professional traders often watch market structure indicators instead. One of these indicators is the lease rate. The lease rate represents the cost of borrowing physical silver for short periods of time. When lease rates begin rising, it can signal that physical metal is becoming more difficult to obtain. Another indicator is the swap spread, which reflects the difference between futures prices and certain physical market transactions. If swap spreads become unusual, it may indicate tension between paper trading and physical demand. Analysts also monitor implied volatility. When volatility begins increasing rapidly, it often means traders expect larger price movements ahead. None of these indicators guarantee a major price move, but when several of them begin shifting at the same time, they can reveal growing pressure inside the system. These signals rarely appear in mainstream financial coverage. They tend to remain visible mainly to institutional traders and commodity specialists, but they can provide valuable clues about how the market is evolving beneath the surface. And when analysts begin seeing multiple structural signals appear together, they often start asking the same question: is something inside the system beginning to change? Up to this point, we have discussed several signals that could support the silver market, but any serious analysis must also consider the opposite scenario, because markets rarely move in a straight line, and there are several reasons why silver may not experience a major rally. First, physical premiums can compress. If industrial demand slows, or if supply chains stabilize, the pressure between physical markets and paper markets could ease. Second, investment flows can reverse. Large ETFs that hold silver sometimes experience significant inflows during bullish periods, but during risk-off environments, those same funds can see rapid outflows. If institutional investors begin selling instead of accumulating, that could place downward pressure on the market. Third, exchanges can intervene during periods of extreme volatility. Raising margin requirements, adjusting trading rules, or introducing temporary restrictions can quickly slow speculative momentum. And finally, macroeconomic conditions could change. If global inflation declines, if central banks begin stabilizing interest rates, or if geopolitical tensions ease, investors may reduce their interest in precious metals. All of these factors represent real risks, and ignoring them would weaken the analysis, because understanding markets requires examining both sides of the argument, not just the bullish case. So if investors want to understand whether the current signals are meaningful, what should they actually watch? Several indicators matter more than others. First, watch whether capital continues flowing toward commodities and hard assets. If the trillion-dollar reallocation story continues developing, it will likely appear through broader commodity strength. Second, monitor industrial demand for silver. Solar installations, electronics manufacturing, and electric vehicle production all influence long-term demand. If these industries continue expanding, they will place steady pressure on supply. Third, pay attention to inventory levels. If physical silver inventories begin declining while futures activity remains elevated, the market structure could tighten. Fourth, observe derivatives market signals. Lease rates, volatility measures, and unusual swap spreads can reveal pressure that price charts alone do not show. And finally, keep watching the macro environment. Global debt levels, interest rate policies, and geopolitical developments will continue shaping capital flows across the financial system. When several of these indicators move together, they often reveal changes in the market before the broader public notices, which is why serious analysts monitor them so closely. At this point, one thing should be clear: the story surrounding silver today is not simply about price, it is about structure. The structure of the global financial system, the structure of capital flows, and the structure of supply and demand across the industrial economy. Right now, several forces appear to be moving at the same time. Global debt continues expanding, interest costs are rising, industrial demand for conductive metals is growing, and capital may already be beginning to reposition toward hard assets. None of these signals guarantee a silver rally. Markets are complex systems. Signals appear, fade, and sometimes reverse. But when multiple structural forces begin aligning, serious analysts start paying closer attention, because large financial systems rarely change direction suddenly. They shift slowly, quietly, and often long before the majority of investors recognize what is happening. Silver has historically been one of the assets that reacts when those shifts begin, not always immediately, but often early enough to reveal pressure building inside the system. So the real question is not whether silver moves tomorrow. The real question is whether the structure of the global financial system is beginning to change. If it is, then the signals appearing today may eventually look very different in hindsight. As always, this is not investment advice. The purpose of this analysis is simple: study the data, understand the structure, and make decisions based on logic, not emotion. Because in financial markets, the most important signals are often the ones that appear before the crowd notices them.